Starting with the concept of the derivatives. Derivatives is basically, we understand, is a financial transaction which has been entered upon, and it derives its value based on spot rate of an underlying asset. That is the technical definition of derivative. Derivative is basically, say, a financial transaction that derives its value based on spot rate prevailing for an underlying asset. That is the technical definition that we have. I am giving you, say, a detailed explanation of the same. Understand it carefully. With certain examples, you will be able to better understand it. So, giving you certain examples with which you will be able to better understand the derivative transactions. For example, that say there is a company in India called Reliance Limited, and this company has exported goods on 1st of January, for which it is going to receive the consideration on 31st of March, and the consideration is supposed to be received in dollar currency. It is $1,000. Whatever the consideration that it is going to receive, we know that of course it is going to be converted into domestic currency, that is in rupees currency. When you do that conversion, at that point of time, what would be the exchange rate? For that, so there is an uncertainty from the Reliance company point of view on 1st of January. So what Reliance company can do? Reliance company can enter into multiple transactions for the purpose of hedging, and one of such transaction is called forward contract. This forward contract is basically an example of the derivative transaction. Suppose the forward contract is entered upon for conversion of the dollar into rupees at the rate of 75 rupees per dollar. Now on 31st of March, let us assume that the spot exchange rate is 77 rupees per dollar. Then in that case, we understand that from Reliance company point of view, the things are not favorable to it. Why? Because it is going to receive 75 rupees only per dollar instead of 77 rupees that it can receive in the spot market. So whatever the less amount that it is receiving is a kind of loss that they have. So this forward contract is resulting into a loss that you will come to know, say, based on the spot rate which is prevailing of dollar currency on 31st of March. So basically the forward contract derives its value based on the spot rate which is prevailing on 31st of March. Now suppose on 31st of March the spot exchange rate is not 75, but let us say that it is 73 rupees per dollar. Then in that case, entering into the forward contract proves to be beneficial. You are able to receive 75 instead of 73. So entering into the forward contract is beneficial to you, and this is what we understand is derivative transaction. What do we understand with the derivative transaction? It is a financial contract that derives its value based on spot rate which is prevailing for the underlying asset, the date on which the transaction expires. What do we understand with the term underlying asset? In the example that we are discussing right now, in that, so the dollar currency is considered to be an underlying asset. This is what we understand is the derivative transaction. Giving you certain more examples to you, to give you explanation of the derivative contract. For example, that I am a company and I manufacture a product. In manufacturing of the product, let us assume that I require one of the component, let us say that it is of copper. I require to buy copper to manufacture the product. Now there is a, let us say that there is a tender of municipality in which I have to fill up a quotation for supplying of this component on monthly basis for a time period of 12 months. I have to supply, say, this product which I manufacture for a time period of 12 months on monthly basis. Now, whenever I am supposed to give the quotation, I need to make sure that say I keep the quotation in such a way so that say I am able to make a reasonable margin, and at the same time say I should not quote say a price say which is going to be loss making to me, neither I should quote a price say with which it should not happen that say I do not receive the quotation. So taking into account the current prices, if at all say submit the quotation, then what happens that say there are fair chances that the price of the copper say may increase, and in that case I will be incurring a loss say in supplying the product later on. It may not be possible for me to store whatever the copper that I will require for the entire 12 months at the current price, and then I will manufacture the product. Practically it may not be possible due to warehouse, so the capacity is limited, or maybe that say I do not have that much funds to buy the product and so on. So what I can do say if at all I become very conservative that say the prices are going to rise, and if at all I submit the quotation, even in that case it is foolishness. Why? Because in that case I will not be receiving say the order. So what I can do, listen carefully, I can just review that what are the forward prices which are prevailing in the market. Whatever the forward prices which are prevailing into that is in the market for copper, taking those prices into account, I can submit the quotation. Once I am awarded with the contract, what I can do, say I will immediately book all those contracts. So what will happen for me, the purchase price of the raw material copper will become constant. There will be a fixed price at which I will be buying the product, and so with that so I can have the supply to the municipality. This is the way the derivative contract works. Derivative mainly, not it is only like this, derivative mainly includes three types of contracts. The first one is what I have recently discussed with you, is called forward contract. Second and third that you might have heard number of times, it is F&O contract. The term F stands for futures contract and the term O stands for option contract. These three transactions are mainly forming part of the derivative transactions. Apart from that, say we have the number of other transactions also called interest rate cap transaction, second interest rate floor transaction, third interest rate collar agreement, fourth forward rate agreement, fifth swap transaction, and so on. That say there are other transactions also which are considered to be the derivative transaction. Initially in our chapter we are going to have the focus on these transactions, wherein we are going to understand that say what is the forward contract, futures contract, option contract. I don't know, you might have heard something like call option, put option, European option, American option, exercise price, strike price, futures price, all those things that say whatever you have studied means whatever you might have heard about, all those things that say we are going to understand over here, and then we are going to have understanding of say the transactions which are called OTC derivative. It is called over the counter derivative transactions. That is what we are going to learn. Recently the institute has also included interest rate futures agreement. That is also the kind of transaction which we are going to have the understanding over here. Now one very important aspect that I want to tell you is this, that See, the very first thing that say I have told you, that say there is a company which has imported goods, or there is a company which has exported goods, or there is a company which has taken loan in foreign currency, or maybe any transaction in which say you have entered upon. In that say due to exchange rate fluctuation, there will be say a kind of say the risk for you. That is the reason so you can enter into certain derivative transactions in order to mitigate the risk. So this is what say we understand is practically the usefulness of the forward contract. The second thing that say we have understood is that say genuinely when you are doing business, in order to fix the price say at which say you will buy the commodity, so for that also you can enter into these transactions. Again in that say the forward contract, futures contract, option contract are possible. However, the institute has included the examples in our curriculum wherein say they are focusing almost on like the stock market only. Stock market is only a part of the derivative concept. However, the institute has included more than 80% examples so of the stock market only. That is the reason say we do not have a choice say but to learn the chapter say from that angle more. But as a student you should be having that understanding, so this is not the only thing that say we have. We understand that say suppose that say I am an Indian company and I have a foreign subsidiary in United States of America, and let us say that say the United States dollar says depreciating. Then in that case what will happen at the time of consolidation of my like the financial statement, I will be I will have to book a loss. Why? Because the dollar currency depreciates in which I have made investment. So there are certain transactions in which again I can enter upon for the purpose of mitigating the risk, that is called technically the accounting risk and not the financial risk. How to do that? So that is also what we are going to discuss. However, the institute has given less importance to say that kind of portion, and say the more importance is given say to the transactions say which are related to the derivative, in which the stock market is included. Even in the option transaction, whatever the transactions that say they have explained us, in that say there are number of strategies that say they have explained to us. For example, vertical spread strategy, then strangle strategy, strip strategy, then say like butterfly spread strategy. All these are the like the strategies in which you can enter upon for the purpose of encashing say the expectation that you have say about the price change. In a way that say suppose at this point of time you are expecting that say the market to go down, then what you can do say in the stock market for the purpose of say making gain. If at all you are expecting the market to go up, then what you can do, that is what you can do for the purpose of making gain, say if at all your expectation fulfills. You are expecting the market to remain stagnant. Even in that case, what you can do for the purpose of making gain, all those things say have been explained to us over here say via say the different strategies, and that is what say we are going to discuss. Right on first point. Derivative is a financial contract that derives its value based on spot rate of an underlying asset. Second point, mainly derivatives include following transactions: In that, write down A, forward contract, B, futures contract, C, option contract. With paragraph, write down, apart from above transactions, comma, following transactions are also derivatives. In that, write down 1, interest rate cap agreement, second, interest rate floor agreement, interest rate collar agreement, forward rate agreement, interest rate futures agreement, swap transaction, full stop. With paragraph, write down, and other such transactions. Full stop. Understanding forward contract from a derivative perspective, let me explain to you. Do not write anything. To explain that, say I am taking like two traders, Mr. A and Mr. B. These are like the two traders, and both of them are having, say, some discussion on 1st of January regarding price of the security Reliance on 31st of January. Mr. B is expecting that the price of the security will be an amount of rupees, let us say 1100, and Mr. A is expecting price of the security will be rupees 900. Mr. A has his own reasons that say why the price will be rupees 900, and B has once again his own reasons that say why price will be rupees 1100. After some like the discussions, Mr. A offers to Mr. B that let us enter into a contract in which you purchase security from me at the rate of rupees 1000 on 31st of January. Listen carefully. Let's say after some discussion, Mr. A is offering to Mr. B that let us enter into a contract in which you purchase security from me at the rate of rupees 1000. In short, that's I will sell security to you say at the rate of rupees 1000. That is what's a kind of offer that Mr. A gives to Mr. B. Mr. B agrees for this. Now my question to all of you is this. Listen to me a question. Suppose on 31st of January, price of security is 600, 1100, 2000. What will be profit or loss to Mr. B for each price? That is my question. I request you to give answer in the chat box. So let us have understanding that's over here. What will happen? Just having an informal discussion before we write anything. The spot price is 600, spot price is 1100, spot price is rupees 2000. The term spot price stands for, spot is an English word which is indicating right now. So the price of the equity share on 31st of January is say provided to us as 600, 1100 and 2000. We are required to make the computation for Mr. B, and Mr. B is having a contract say to purchase the security at the rate of rupees say 1000. So what will happen? We understand that say he will buy the security, purchase the security at the rate of 1000 rupees. And dear students, for the purpose of making calculation of the notional gain or loss, we are making a small assumption that on that date only the security is sold. So it is sold at the rate of 600, so there is a loss of rupees 400. It is sold at 1100, so there is a profit of rupees 100. It is sold at rupees 2000, so there is a profit of 1000. This is the way Mr. B will have the profit or loss say for each of the spot price. Now if at all we are required to make the computation from Mr. A, then in that case we understand that the situation will be exactly that is the reverse. Spot price is 600, spot price is 1100 and spot price is 2000. Mr. A is having a contract in which say he is supposed to sell the security at the rate of 1000. So again sale price, purchase price and profit or loss. Again, like we are just making an assumption that from 1st of January to 31st of January, Mr. A is not entering into the transaction to buy the security. We are assuming that say on the last day only, let us assume that say he is purchasing the security at which price? At the rate of rupees 600 to be sold at 1000. At 1100 it will be purchased and at 1000 it will be sold. Purchasing at 2000 and selling again at 1000. So there is a profit of 400, there is a loss of 100 and there is again a loss of 1000 rupees. This is what we understand. Now friends, in a technical language, say this transaction that we have understood is say given a name as say the forward contract. As what you can see that say over here, say there will be two parties say to a contract. One is say given a technical name as say the forward buyer of an underlying asset and there is a forward seller of an underlying asset. The transaction is entered upon so on a particular day for a particular day. The price at which say the transaction will take place is predetermined, that is it is determined on the day on which the transaction is entered upon, that is 1st of January in this example. The underlying asset is over here say the security of the Reliance company. So over here we understand that say the transaction is entered upon for an underlying asset. it may be gold, it may be copper, say it may be any other thing also for which say you can enter upon the forward contract. We understand that say when the forward contract is entered upon for the purpose of speculation, then in that case the forward seller is expecting the price to fall down. When it is entered upon for the purpose of speculation, then basically the forward seller is expecting say for the that is expecting that the price of the security, that is underlying asset, will fall down. You can see that say when the price is falling down to rupees 600, then in that case Mr. A is able to make a profit of rupees 400. We can say that say he is bearish for the market, and say a trader who is entering into the transaction to buy is say basically bullish for the market. Bullish means that say he is expecting the price of the security to go up, and if at all the price of the security is going up, then in that case he will be able to make profit. That is what say we understand. Importantly over here, on 1st of January there is only exchange of words. There is nothing to be paid by any of the party to another one. So there is no investment that say you are required to make, say in case of the forward contract. What will happen in case of futures contract, option contract, that we are going to discuss later on, not at this point of time. But in forward contract we understand that say you don't have to make any investment right now, and whatever the profit or loss, say for that, say that is it will be exchanged say at the end of the period, that is over here on 31st of January. This is the way the forward contract works. Now after the second point, right on the third point, derivative transaction can be entered upon for the purpose of read on A, hedging, in bracket write down, mitigating or eliminating risk. B, speculation. C, arbitrage. Now what is arbitrage, that I am going to discuss slightly later on. With paragraph write down, derivative transaction is useful for hedging purpose comma in a number of situations. For example, 1, export / import and consideration is in foreign currency, comma, to be settled in future. Second, for repayment of foreign currency loan. Third, for purchase of raw material, goods, full stop. Fourth, for borrowing at floating rate of interest, full stop. Fifth, for hedging long slash short position in cash market. Sixth, for future borrowing slash investment. Next, investment at floating rate of interest, with paragraph write down, and other such many examples, full stop. Fourth, speculation means considering expectation of price change of an underlying asset, certain transactions can be entered upon for making a gain, full stop. Different transactions will have different risk and return. Fifth point, arbitrage means taking an advantage of price differences, full stop. What is that? I'll explain that to you later on. Heading right down, forward contract, in that first point, in forward contract, comma, there are two traders, comma, who have contract with one another to buy, comma, to sell an underlying asset at the rate forward price. Second point, in forward contract, there is no payment or a receipt at the time of entering into contract. Full stop. Third point, forward buyer is expecting price of underlying asset to increase and forward seller is expecting price of underlying asset to fall down. Full stop. Let us see our question. Mr. X is estimating price of the Reliance to increase. So he is entering into a forward contract of purchasing a share of Reliance on 31st of July at the rate of rupees 100. Spot price of the share on 31st of July is, the different prices have been given to us. For Mr. X, you are required to calculate. The first is the profit or loss for each of the spot price, and the second is you are required to show the diagram for the profit or loss that say he is making. Try to complete the answer of the question, then I will do working for you. Chalo, write down answer. Heading is calculation of profit or loss to Mr. X. In bracket I am writing forward buyer, bracket over, for each of the spot price of security. So column number 1 will be spot price of the security on 31st of July, then sale price, then buy price, and lastly it is the profit or loss. This is the way we are required to complete the table. So over here we understand that Mr. X is having a contract to purchase a security at the rate of 100 rupees. So again we have a simple assumption that say we are going to buy on the last day only. So 100 rupees is the price at which you are going to buy. And we are having an assumption that say on the same day, say it will be sold, no value, 40 rupees, 100 rupees, 170, 200 and 10,000. So there will be a profit or loss, loss of 100 rupees, loss of 60 rupees, no profit, no loss, profit of 70, profit of 100, profit of 9,900. That is the way the profit or loss for the different spot price of the equity share can be calculated. Basically, we are taking the two extreme prices over here. One is very less price, 0, and another is a huge price, 10,000, to understand that say what will happen say in case of the extreme price change. Now we are required to show this via a diagram also. In that say we will be having say working something like this. On x-axis we will take the independent factor, that is say the spot price of the equity share. So on x-axis we will take spot price of the equity share on 31st of July, and on y-axis we will be taking the profit or loss. This is the way we are required to show the diagram. In the diagram, my suggestion to all students is usually start with the 0 value. When the price of the security is 0, then in that case there is a loss of 100 rupees. So we have a plotting over here for an amount of 0 rupees of the spot price, there is a loss of 100. Gradually we can see that the loss reduces, you reach to the break-even point, you make a profit. And we understand that say there is an unlimited profit potential. So the graph is going like this. We do not have to plot 10,000 rupees, we just have to show this in form of a diagram. This is 100 rupees, a kind of break-even point. And over here we understand that say this value is going for unlimited amount. This is going for unlimited amount. This is the way say we are required to show the diagram.